let's talk about segregation of duties and internal controls when we get to our revenue cycle. Well, again, we're talking about anything here. We need to have professional skepticism. And when we talk here in the exam and throughout all of audit, we usually are going to examine areas that can be overstated and susceptible to fraud. But in addition to that, we're also going to test to see if accounts are understated, likely due to error. So we're concerned about error and fraud. Now, while revenue, yes, the concern is that it usually will be overstated by management because they're trying to look better. We're also concerned about it being understated because of error. So that's just something to take into account. Yes, we want to put extra emphasis on the concern that revenue is overstated because of fraud, because, well, people actively try to commit fraud, whereas errors just happen, and you don't really try to commit an error, it just happens. Right? Revenue could be over or understated due to an error, and that is a concern as well. So, yes, we want to make sure the financial statements are accurate. We're not the police. We're not trying to make sure that they don't reach above a certain level. We want to make sure that the numbers are accurate, right? We're here for the benefit of the shareholders. Whether that number is good or bad, we don't care, as long as that number, that revenue amount, is accurate. So just a point to keep in mind overall. Now, we have this in internal control, talking about fraud and everything in those lessons, but we want to separate authorization, record keeping, and custody of assets, making sure that those who have the ability to authorize transactions do not have custody of anything involving those transactions. Those who have the ability to authorize cash disbursements never touch the cash and are not the ones who record the disbursements of cash. Because if you have any two of these functions, then you could fudge the financial statements, right? If you can authorize cash to be used up and then you have custody of that cash, you can then steal that cash. So not good. You want to make sure these are separated out and that one person has one of these and they're all separated out. There's 3 different people involved. Here are some ways to test the segregation of duties related to revenue. Here are tests of controls, right? Testing the internal controls. We can verify that different employees are responsible for these processes, initiating, authorizing, recording, and reviewing revenue transactions. We can also inspect supporting documents to verify those transactions. Reviewing ownership of revenue accounts, seeing who is recording in the books, is someone who should not be recording the revenue amounts in the books doing it. We can check that revenue processing is approved by management, making sure that the authorization process is actually functioning as it's supposed to. But even though if management approves and someone else is the one who has custody and someone else is doing the record keeping, does the approval process actually work? If we submit a fake revenue transaction, not like fake because we're testing the system as the auditor, is that going to properly get authorized, or does management just ignore it and just authorize every single transaction without looking at it? We can also examine that appropriate reviews and approvals are performed over revenue transactions. We can investigate whether funds related to revenue are received and deposited by the same employee, which would be a breach of our internal controls. We can verify the accuracy of journal entries. That's obviously very important as well. And lastly, we can ensure that sales orders are sent to the credit department for approval before filling the order. Like I said, you're not going to accept every single sale, because then you're going to accept sales for some people who are not going to pay you. You want to make sure the credit department has the ability to take a look first and decide, should we actually sell to this person, or is there a chance that they're not going to pay us back? Moving on, and we're going to see this common theme that I've built out for each cycle. We're going to see a slide that talks about how to account for proper segregation of duties, then internal controls, and then we'll see how to address each assertion within each cycle. So now we're on this slide going through the internal controls for the revenue cycle. And these are all going to be internal controls, obviously. And again, specific to the revenue cycle. Now, not saying that they can't be used for, let's say, the cash cycle or the expenditure cycle. However, these are going to be specific ones that you should know, be familiar with, and most importantly, that you should look at and it makes sense to you. So if it doesn't make sense, obviously come back and rewatch the video, but let's dive in. First off, observing. So these are examples of the internal controls, and this is how the auditor is conducting those tests of controls. So if an auditor is observing an entity's employees prepare the schedule of past due accounts receivable, that is the auditor taking an action to observe, in this case, how the employees prepare the schedule of past due receivable, which this is an internal control. Preparing this schedule allows the company to see which accounts receivables are past due so they can follow up on those receivables, the money owed to them, and they can, again, make sure that they get paid. So if this internal control is not properly conducted, then that's going to obviously mess with a lot of numbers. I mean, obviously, it'll affect the profitability of the company. You won't be collecting as much when it comes to the receivables, but also it could totally skew numbers related to that account balance. Next up, reviewing the policies and procedures for processing payments from customers. This is something that if this control is not followed, then obviously we'll have some significant issues in that regard. Inspecting the documents and records related to the accounts receivable process. In general, inspecting documents and records to any process is going to be helpful. Inquiring about the accuracy of the accounts receivable reports. Now, inquiries are great, but they usually need to be followed up by an actual procedure. Observing the segregation of duties among employees in the accounts receivable area. Right, you could also just substitute accounts receivable with accounts payable or cash area or anything, and that would apply to most cycles. Examining the authorization process for approving customer credits and refunds. Now, if this doesn't work properly, the employees there could be collaborating with customers to maybe give them a refund when they don't actually deserve it. If this is not operating properly, employees could potentially be running their own schemes and scams within the company. So you want to make sure there is a legitimate authorization process acting in the interest of the company. Tracing transactions from the point of origin through the accounts receivable system. This is going to basically involve absolutely everything there. Testing the accuracy of the AR balances through substantive testing. Investigating any unusual or unexpected patterns in the AR activity. I would say this has very much analytical procedures written all over it. Now, these procedures assist the auditor in providing evidence regarding how controls were applied, the consistency with which controls were applied, and by whom or what means controls were applied. Now, for example, these two items, these are not tests of controls. This is a substantive procedure, and this is analytical procedures. However, you can conduct these to essentially see how well the internal controls are operating. If you're finding a lot of issues, and then you can trace it back to an underlying issue within the internal controls, there you go. You've done essentially a test of control. Let's talk about existence as it relates to auditing the sales balance. Now, existence, another trend you'll see, this paragraph is going to be the same. And whenever we get to different assertions, the descriptions of them will be the same. The purpose of this is to reinforce them. We're going to see existence and everything related to that as it comes to each cycle, the expenditure cycle, the cash cycle. And obviously, I want you to completely have these memorized. And I think over time, obviously, reiterating them time and time again will do that. Here, we're going to see that we're going to verify the existence of sales by doing these procedures. So existence is the assertion that the entity actually has the asset or liability, as we mentioned. It's usually more physical. Completeness is the assertion that all transactions and accounts should be included in the financial statements of an entity have been included. And occurrence is an assertion that transactions and events have occurred in the proper accounting period and have been properly recorded. Now, you'll see here, we may not see all three of these. The next slide is probably going to cover completeness. However, the goal here is these are the ones that kind of are grouped together based on what I showed you before on that little chart I had. So I want to just group the ones together that are similar so you see the differences. And then obviously, we're going to break out the types of actions taken for each assertion. Now, an auditor would verify the existence of sales, the fact that sales actually exist, that these specific transactions actually happen by examining the customer's contract. Now, I know I keep jumping around everywhere. It's all solid points, but I want to just remind you again, I mentioned this before, that you can have one procedure that assists with multiple assertions. So for example, when it comes to the sales journal, right, with the cash and credit sales, you really need to think about what's included in each record. You got to think, okay, this journal entry within cash and credit sales, the standard journal entry is going to be the debit to receivables, credit to sales, and then you're going to have a debit to cash when you receive it and a credit to receivables. Think about also possibly bad debt expense, anything like that. Each assertion is going to have different amounts of testing actions. So there's just, for example, with completeness and valuation, we could very much turn to our confirmations. For AR, we're going to see that. And that's really the best way to deal with accuracy when it comes to accounts receivable, is just doing the confirmations. Whereas verifying the existence of sales, we see that we have a good amount of different actions to be taken. Examining the customer's contract, if we're looking at the contract and seeing, okay, contract says we should be receiving payments. This is when we're recognizing revenue, etc. Receiving and reviewing customer purchase orders, showing that the customer actually wanted to purchase something from the company. That's pretty important, because if they didn't actually purchase something, it could be a fake sale. Inspecting shipping documents. So tying all this up together, right? The cycle is the customer, and we'll see the flow chart of this in a bit, but customer is going to put in a purchase order, we process it, we approve it. So every document here is going to have to tie. The purchase order is going to have to tie, and then purchase order is going to go for approval. That's going to have documentation showing that it was approved. Then we're going to have the processing documents. We're going to then have the shipping documents where we ship it to the customer. Then we're going to have the invoice. We're going to invoice the customer. Then the receipt of the actual cash or the check, whatever we get. So you see how that's all going to tie together, and we have to tie together all these documents. Examining copies of invoices, confirming with customers that they actually received the goods, because all of these things should have happened if it was a legitimate sale, not just a fake sale being recorded for the sake of bolstering the financial statements. We've got tracing transactions from the sales journal, which includes both cash and credit sales as compared to the cash receipts journal or the AR detail listing. So for example, the sales journal, like it mentions here, it's going to have all the sales. So think about what you're looking at. Because if you look at just the cash receipts journal, which is a specific subset journal that only has cash receipts, that's not going to have absolutely every sale, because like I said, we have a general trend that we're going to usually do credit sales, but obviously there will be cash sales as well. So if you look at just the cash receipts journal, which is going to have just cash receipts and cash transactions, the AR detail listing is going to have just credit sales. Those by themselves don't give you an idea of what the sales are. You got to put them together, which gives you the sales journal. So again, just to reiterate that, the cash receipts journal plus the AR detail listing journal should give you the total sales journal, because this is cash sales, this is credit sales, that gives you the total sales. So thinking, and this is one example, but whenever you're looking at a document, like close your eyes and think, how does this fit into the bigger picture? Is there any reason why we would need additional documentation, anything like that? So tracing transactions from the sales journal, which is the documentation, the internal accounting system detailing what the sales have happened, to the shipping documents to detect the possible fictitious customers and or sales which would have been reported to overstate revenue. Like I said, follow the logical, natural process of a sale and make sure that documentation exists in every step of this sale. Additionally, sending positive AR confirmations would detect fictitious customers or sales. As one final point here regarding fictitious AR, an auditor may believe that there's a material misstatement in the AR account from fictitious customer accounts if AR confirmation requests yield significantly fewer responses than what were expected. When we see AR, we're going to go over this whole process of confirmations much more. But essentially, right, you've got a form, you send that form to a customer, you're the auditor, you're asking the customer, hey, did you actually buy 3 pieces of inventory at $1,000 in total from this audit client? And they'll write back, hopefully, and they'll say, yes, we did. And then you can say, that's good to go. But if you don't hear back and it's a fake address, that would be a fake sale, because a company could record a fake sale, say, oh yeah, we sold something, right? And that overstates revenue. That's something to watch out for as an auditor. Let's keep moving along. You are this expert auditor here. Now we're seeing completeness, right? We just did existence. Now we're doing completeness. You're going to see a lot of similarities here. Of course, we're going to see similarities because existence is that the entity actually has the stated transaction, and completeness is that all transactions that should be included have been included. Like I said, in some cases, they're going to be very similar. In some cases, they'll be different. It just depends. How would you verify completeness? Well, you're going to review the general ledger accounts for any unrecorded sales to ensure that all have been recorded. Okay, right? Tracing, vouching, analyzing the sales journal to check if all sales have been recorded. Examining bank deposits and accounts receivable ledgers to ensure that they're in line with the sales recorded. Checking the physical inventory count against the sales records. If we started out with 1,000 units of inventory, we said we sold 400 of them. Well, we should have 600 left. Just do some simple math. Tracing transactions from the customer's purchase orders to the sales journal to ensure that all sales have been recorded. Examining AR and cash receipts to confirm the validity of sales. Just like I said, the journal entries. The journal entries should all add up. And lastly, here we have tracing shipping documents to the sales invoices. So we say we shipped 10 pieces of goods to the customer, and then the invoice that they sent the customer should have said, hey, that's for 10 items of inventory. To search for possible understatements of sales. Like I said, the concern inherent is that they're going to overstate sales, but it's also our job to check for potential errors, which would have accidentally possibly understated sales. In testing completeness, the auditor would start with the supporting documentation, which is the shipping documents, and this is the process of tracing, right? We We talked about tracing and vouching. We said that tracing is usually more associated with completeness. That's like stuff like this I would definitely memorize. Like this is all gold. Just as a note from me, I mean, these are all notes from me, but stuff like that chart I showed you before, the fact that tracing is usually associated with completeness, memorize that because that's just going to give you so much possible help on the exam. Because if you see a question, what's the proper procedure if you want to do completeness for sales? Well, if you see an answer that has to do with tracing, odds are that's the answer. So enough of that little tangent, but that incredibly helpful there. In testing completeness, the auditor would start with the supporting documentation, which is the shipping documents, and trace forward to reconciling the accounting records, such as the sales invoices and sales journal. Again, just think about the logical process of how a sale happens. And again, I'll show you a flow chart. It's going to be a few slides. By a few, I mean, probably a good amount. If the auditor finds a shipping document that does not have a corresponding sales journal entry, this would indicate that the sale was never recorded and thus sales are understated and not complete. Right? What could happen is that you ship the inventory to the client, but you forget to invoice them or you forget to record it. And that's a problem. That's incorrect financial statements. And, again, whether it's intentional or just an error, it's your job as the auditor to help get those financial statements as accurate as possible. And just the caveat, materially as accurate as possible. Let's talk about occurrence. Now, occurrence is the assertion that transactions and events have occurred in the proper period. So let's make sure that, maybe the sales number could be perfectly accurate, right, over a 2-year period, but let's make sure that each year actually reflects the sales that happened in that respective year. Here we can examine canceled checks, customer invoices, and other documents related to sales transactions. Basically, what we can look at here is just piece together in each transaction, big or small. Maybe it's just a massive construction contract or individual items and pieces of inventory that were sold, but piecing together the dates and kind of painting a story in your head of what actually happened, right? Getting an idea, that's obviously incredibly helpful. Counting physical inventories to ensure that all goods shipped have been recorded as a sale, similar to what we just saw with completeness. Verifying that all goods shipped have been recorded as a sale. Definitely an important task there. Investigating any unusual or large sales transactions. Generally, you're going to do this for basically any account, right? If you have any abnormally large or unusual transactions, you should definitely investigate them, whether it's debt or investments or anything like that. Testing the validity of sales deductions, any returns, allowances, discounts. Using analytical procedures on invoice amounts, sales order quantities, and customer account identification to perform substantive tests. That would be great there to verify that they're in the correct period. We're going to use analytical procedures throughout all of these inputs. Lastly here, examining accounts receivable and cash receipts to confirm the validity of sales. If a sale is real, you should have recorded a receivable for it, and then you should have received cash as well. Now, if you didn't receive cash because they didn't pay you, well, obviously there would be documentation and other journal entries instead of just the normal receipt of cash. Let's talk about evaluation, allocation, and accuracy. Now, like I said, these are going to repeat over and over. And let's just see this for the first time here. The valuation assertion relates to the dollar amount. So if you want to memorize that, valuation has to do with the dollar amount of an asset, liability, or equity. Allocation refers to movements of amounts from one account to another. So we could have different bank accounts. And if you think back to audit evidence, we've got that lesson there. We could have maybe 3 bank accounts, 3 cash accounts, and we could have account 100, account 101, and account 102. It's important to make sure that these all have the proper amount. Now, maybe in the aggregate, all of these equal the correct cash amount. However, this is accounting, right? We're trying to account for this properly. Each cash account should have its own proper amount in there, and that would be the allocation. Was the correct dollar amount allocated properly among the different accounts? Then next up, the accuracy assertion relates to the correctness of the financial statements. Are they accurate? And as we saw earlier, it relates to errors. So making sure there's no errors. Now, how would the auditor test all 3 of these? We would examine supporting documentation of sales transactions, such as selecting a sample of sales invoices and tracing them to related shipping documents, which could detect overstatement of revenue from fictitious sales being recorded. Really just tying everything out. And again, like I said, a lot of these we've seen already. We've seen a lot of these different potential tests. And like I said, we can have a test that works for multiple assertions. We've got great resources here, but I would definitely keep your own list. Like write it out in a format that works best for you, that's best for you to visualize. Next, inspecting the accuracy of the recorded sales data. Awesome. That's obviously quite on par with accuracy. Verifying the existence of sales and the associated revenues. Well, to make sure that sales actually exist is going to help with the accuracy. A lot. Accuracy, for example, accuracy can have a lot of different tests because basically any test is going to help you with detecting errors. Analyzing the completeness of sales transactions, obviously, again, that'll help with accuracy. Checking the accuracy of sales cutoffs, that could help with allocation, the proper valuation. Assessing the validity of any related party transactions. If a related party transaction is not a legitimate transaction, then obviously that would affect the accuracy and possibly these other assertions. And lastly, here, checking selling prices against an approved price list. If any salespeople were selling things at the incorrect prices, whether it's because they're trying to be aggressive and overstate those prices, or maybe they made an error and they recorded it at a lower price, you want to make sure that these sales are as accurate as possible. Having a good time here. Make sure you're stretching. Make sure you're drinking your coffee. Hydrate. Get some water in you. Have a smoothie. I love smoothies. I think they're wonderful. Get some fruit in you. I think it is delicious and good for the body. Take care of your body. Let's keep powering through. Now we're going to talk about cutoff when it comes to sales transactions. And the cutoff assertion is used to ensure that transactions are recorded in the proper period. Like I said, you want to make sure that you're not recording a year one sales transaction in year two, and vice versa, year two and year one. Now we've got some repetition here. We talked about completeness and occurrence, but these are kind of similar to each other, so I wanted to bring them back. Completeness assertion is used to ensure that all transactions are recorded in the accounting records. We see cutoff is making sure that they're in the proper period, because let's say for a 2-year period, you could have the correct number, but are they properly allocated or cut off into the correct periods? That's obviously a concern. Completeness is, like I said, making sure that all transactions are recorded in the accounting records. The occurrence assertion is going to be used to ensure that transactions and events have occurred in the proper accounting period and have been properly recorded. The cutoff assertion is closely related to completeness and occurrence. That's why we've kind of brought them back, as I mentioned. Now, how would you test the cutoff of sales? Here, you could test credit sales made before the end of the year to see if they've been properly recorded in the current and correct year and not in the subsequent year. You really just testing towards the end and the beginning of the year. Obviously, that's what cutoff has to do with. It's making sure something's recorded in the correct period. So both of these are going to kind of deal with testing transactions around that end and beginning of the year. But if you test these credit sales, just make sure they're recorded in the correct year. Now, if the sale actually happened on 12/31, well, make sure it's recorded in that year and not accidentally 2 days later. If any transaction in the middle of the year, you're not going to really worry about this, because if you record it 2 days late, it's still within the same year. But obviously, if you get to the end of December, and if we're dealing with a fiscal year, you get some issues where someone records it 2 days late and they accidentally put it in the wrong year. Next, testing shipping cutoff procedures to ensure that sales are not recorded after the cutoff date. Shipping, this could be a big concern, right? If you think of FOB shipping point, FOB destination, ensuring that the terms are reflective of when the goods change hands and whenever the sale is considered complete. Presentation and disclosure, dealing with presentation and classification. The understandability of presentation assertion relates to ensuring that information included in the financial statements has been appropriately presented and is clearly understandable. This means obviously any related disclosures are included, and overall, just everything could be understood by your average financial statement reader. The classification assertion states that the information provided in the financial statements is presented accurately and in the proper categories, such as short-term versus long-term. Makes sense, pretty straightforward. Now, really, how would you test the presentation and classification of sales? You are going to make sure here that earned versus unearned revenue is properly broken out, and earned revenue is revenue, right? It goes in the income statement. However, unearned revenue, what is that journal entry? Well, you're going to receive cash, you're going to debit cash, but you're going to credit unearned revenue, which is a liability account. Obviously, big distinction here, because this is a liability on the balance sheet. This is a revenue on the income statement. Ding, ding, ding. Don't let misclassification happen.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.